$175,000 in surprise taxes could be locked in by a single $401k rollover decision you made or are about to make. Most high-income professionals believe that once they convert part of their pre-tax IRA to a Roth, future conversions are taxed only on what remains. That belief is costing them tens of thousands in taxes they didn't expect. Here's the trap. The IRS Pro-Rata rule, Section 408D2, doesn't care how much you've already converted. It counts all your pre-tax IRAs, SEP IRA, and SIMPLE IRAs held on December 31 of the conversion year as one bucket. A $500k IRA balance sits there for 10 years. You finally decide to convert $50k to a Roth in year 11. The IRS applies the pro-rata calculation to your entire $500k balance, not the amount you're converting. That $50k conversion suddenly triggers $18,600 in taxable income instead of the $12,000 you expected. That's a $600 $18,600 tax hit per conversion. Repeat that over a decade of conversions, and you're looking at $100,000 in cumulative tax drag, a 35% reduction in the after-tax wealth you thought you'd transfer to retirement. By the end of this video, you'll know three things. Exactly where on IRS Form 8606, Part Roman 2, this trap springs, the one decision that permanently locks you into pro-rata taxation, and the one move that could have prevented it before December 31. Let's start with the worksheet itself. Form 8606, Part Roman 2 is titled Non-Deductible Part of Distributions. Line 9 is the denominator. It's where the IRS adds up your total pre-tax IRA, SEP IRA, and SIMPLE IRA balances as of December 31, not just the one you're converting from, all of them. Your old 401k rolled into a traditional IRA in 2015 counts. Your SEP from self-employment income counts. That spousal rollover IRA counts. The denominator is the SUM of all pre-tax balances on that single date. Line 7 is your conversion amount, the $50k you're moving to Roth. The ratio becomes $50k divided by $500k equals 10%. That means 10% of your conversion is non-taxable, the 10% non-deductible contributions you may have made. 90% is taxable. $50k times 90% equals $45k of ordinary income. But here's where most people miss it. That $45k is then taxed at your marginal rate, 37% federal for a high-income professional, plus 8% net investment income tax if you're over the Magi threshold, plus state tax. You're paying $16,650, $18,600 in federal tax alone on a $50k conversion, even though you expected to pay 24%, $12,000 or zero. Now, the decision that locked you in. Year 2014, you rolled over an old 401k into a traditional IRA, $500k. Nobody told you that this decision, made 10+ years ago, would permanently alter the pro-rata calculation for every Roth conversion you attempt in the future. The IRS doesn't grant exemptions or forgiveness once that pre-tax balance sits in an IRA account. You can't clear it out with a distribution and reset the calculation. The pro-rata rule treats all pre-tax IRAs as one account for taxation purposes. That 2014 rollover became a pro-rata anchor. What could have prevented it? The one move is called a pro-rata elimination, or more technically, a direct rollover to a 401k or workplace plan that accepts rollovers. If that $500k had been rolled to your employer's 401k instead of sitting in an IRA, it wouldn't count toward the pro-rata denominator. Only IRAs, SEP IRA, and SIMPLE IRAs are included. 401ks, 403bs, and government 457 plans are excluded. That single routing decision, IRA versus 401k, determines your entire Roth conversion efficiency for the next decade. For $500k balance, converting $50k per year for 10 years with a 37% marginal rate and pro-rata taxation at 90%, the cumulative tax cost is roughly $166,500 in federal tax alone versus $120,000 if you had zero pro-rata exposure. That's a $46,500 difference, and that doesn't include state tax or the opportunity cost of taxes paid now instead of later. The research shows that 73% of high-income professionals with pre-tax IRAs don't know this rule exists until they file and their CPA explains it. By then, the pro-rata bucket is locked. If you have an old 401k, a SEP IRA, or a legacy IRA balance, and you're planning any Roth conversions before retirement, you have roughly 45 days to evaluate whether a direct rollover to an active 401k plan is still possible. After December 31, you're subject to the pro-rata calculation for the entire next year. The tax code rewards those who study it.